We're in the middle of a war right now, and
Mhm.
it's not being fought with drones or, the usual
No,
sanctions.
not visibly anyway.
It's being fought in the plumbing, the deep plumbing of the global financial system, and the outcome is going to decide if your money is it a tool for freedom or a
Mhm.
tool for surveillance?
It's the invisible money war, and honestly, most people are just not paying attention to it. It's this three-way battle between government digital currencies, the private crypto world, and the big geopolitical rivals of the West.
And that is exactly what we are breaking down today. It's Sunday, January 25th, 2026. We have a huge stack of research here, reports from Big Brother Watch, some dense technical papers from the European Central Bank and the BIS, and a brand new 2026 market analysis from Rapid.
Right.
The mission is pretty simple. Is the future of money dystopian control, or is it just ruthless corporate efficiency?
I think it's probably a mix of both, but some of the specifics in these reports are, I mean, they're genuinely startling. This isn't theoretical anymore. As of right now in 2026, the pilots are live,
No.
the laws are passed, and the battle lines are drawn.
Okay, let's start with the government side of this whole equation. Central Bank Digital Currencies, CBDCs, we've been hearing about them for years, but this report from Big Brother Watch, it drops a pretty heavy hammer on the privacy side. They looked at pilots in Israel, Nigeria, China, Jamaica. What's the reality on the ground?
The reality is the privacy concerns are completely valid. The report explicitly quotes the Bank of Israel about their digital shekel pilot.
Mm.
And the central bank admitted, this is on the record, that absolute privacy will not be possible.
Wow, that feels like them saying the quiet part out loud. Usually there's a lot of dancing around that.
They do, but from a central banker's point of view, that's a feature, not a bug. I mean, their mandate is to stop money laundering, stop tax evasion.
Yeah.
You just can't do that with a digital currency that acts like anonymous physical cash.
Right.
If the central bank issues the money, the central bank wants to see where that money goes.
But the Big Brother Watch report suggests it's more than just watching. It goes into linking.
Yeah.
You brought up Jamaica.
Right, the Jamdex. The report highlights that the digital wallets there are being linked directly to biometric IDs.
So your fingerprint, your face.
Exactly.
Yeah.
So your ability to even transact is biologically tied to your identity.
Yeah.
If you get locked out of the system, you don't just lose a bank account. You lose the ability to participate in the economy at all.
And that leads right to this concept of programmability, which is where, all the dystopian fiction starts. But we're seeing it in practice in China with the digital yuan.
And this is the most critical distinction for listeners to get their heads around. The difference between just digital money and programmable money. The Big Brother Watch report, it details how the digital yuan is already being used to nudge behavior.
Nudge is such a soft word for what's essentially behavioral engineering.
It is. We are talking about money that can literally have an expiration date.
So a stimulus check that just vanishes if you don't spend it in 30 days.
Precisely. Or, in a more extreme scenario, money that you're blocked from spending on certain things. Maybe plane tickets, maybe alcohol, based on your social credit score.
This is exactly what the European Data Protection Supervisor, the EDPS, warned about in their report. They called it a risk of systemic public surveillance. If you have one central ledger of every single transaction, you create what they called a honeypot.
Exactly. I mean, even if you trust the government of today with all that data, you're building a database that becomes the #1 target for every hacker and every rival nation state on the planet. If that thing gets breached, it's not just credit card numbers. It's a complete map of everyone's life.
But here's where it gets really interesting. The report notes that even with the government pushing this so hard, adoption has been terrible in a lot of places. Nigeria's Onara pilot was basically a ghost town. Why is that?
Distrust. Or, the lack of it. In Nigeria, the public already had a deep distrust of the government's financial management. So when the government comes along and says, hey, use our new trackable digital token instead of cash, the population just said, no thanks.
They just stuck with what they knew.
They stuck to physical cash or they moved to private crypto. It's a classic case of product-market mismatch. The product was surveillance, and the market just didn't want it.
So adoption fails when it's forced. Okay, let's slip to the other side of the Atlantic. The European Central Bank, they're not ignoring these fears. We've got a progress report here on the digital euro where it seems like they're trying to thread a really fine needle between control and privacy.
Yeah, the ECB is taking a much more sophisticated approach. Fabio Panetta, who's a leading voice there, he argues the digital euro isn't about replacing cash or spying on people. It's about providing an anchor.
Okay, let's unpack that. Anchor sounds like banker speak. What does that mean?
Well, think of it this way. In a crisis, people lose trust in private banks. They worry their bank might go bust. Right now, physical cash is the only public money you can hold that's totally risk-free.
It's a direct liability of the central bank.
Exactly.
Oh.
So Panetta's argument is that as cash disappears, we need a digital equivalent, a public option that stands firm even if the private sector gets shaky. He sees stablecoins and commercial bank money as complementary, but they need that public anchor to stay stable.
And to sell this idea, they're promising an offline mode. The idea being that for small amounts, I can tap my phone to yours, transfer some digital euros, and that data never even touches the central bank's servers.
That is the promise. It's supposed to mimic the privacy of cash for, buying a coffee or whatever. But the report also clarifies that once you go back online, or if the amount hits a certain limit, all the anti-money laundering rules kick in. So it's more like conditional privacy.
And speaking of conditions, the ECB report explicitly denies the whole programmability fear. They say, flat out, the digital euro will not be programmable money.
They make a very sharp distinction. They say they support conditional payments, like setting up your rent to go out automatically on the first of the month. That's just convenience.
Yeah.
But they claim they will not program the money to restrict what you can buy. They are trying very, very hard to distance themselves from the Chinese model.
There was one technical bit in the ECB papers I found surprisingly clever. This waterfall approach. This is their solution to the bank run problem, right?
It is. It's a big deal. The biggest fear commercial banks have is that if a digital euro exists, everyone will just pull their money out of their risky commercial accounts and stick it all in a totally safe central bank wallet.
Which would collapse the banking system overnight.
It would. So the waterfall prevents that. Let's say there's a holding limit of 3,000 euros in your digital wallet. If you sell your car for 5,000 euros and the money lands in your digital euro wallet, the system automatically sees you're over the cap. The excess, the waterfall, just immediately spills over into your linked commercial bank account. You never actually hold more than the limit in central bank money.
So it keeps the commercial banks in the loop. They're still the main place you store your wealth, and the digital euro is just for transactions.
It's a compromise. It keeps the plumbing of the current system alive, but it upgrades the pipes. But, while Europe is tinkering with waterfalls and privacy, the real geopolitical game is happening in the East. We have to talk about Project Enbridge.
This is the part of the research stack that feels less like banking reform and more like economic warfare. The headline number from the BIS and Ratum sources is just huge. $55 billion processed on the platform.
And look, in the grand scheme of global finance, that's still a drop in the bucket. SWIFT moves trillions. But $55 billion for a pilot program with central bank digital currencies? That's massive. And the makeup of that volume is the real story.
95% of it is in China's digital yuan, the ECNY.
Precisely. Enbridge is a platform that connects the central banks of China, Hong Kong, Thailand, the UAE, and now, as of 2024, Saudi Arabia. It lets them settle payments directly with each other.
And to get why that matters, you have to look at the alternative. If a company in Thailand wants to pay a supplier in the UAE today, what's the process?
In the traditional correspondent banking system, that money usually has to travel through a big Western bank, often in New York. It gets converted to dollars, compliance checks are run, fees get taken, and it finally settles days later. It's slow, it's expensive, and, this is the crucial part, it puts the transaction under U.S. jurisdiction.
Because it touches a U.S. bank, the U.S. government can see it, and they can stop it.
They can stop it, exactly. Enbridge creates a teleporter. The Pi bot goes in, and the UAE dirham comes out, almost instantly. It completely bypasses the U.S. dollar and the U.S. banking system.
Which explains why the Bank for International Settlements, the BIS, suddenly got cold feet. I mean, they were the architects of this thing. And then late last year, they basically just handed the keys to the countries and walked away.
That was a huge signal. The BIS is based in Switzerland. It's Western aligned. They realized they had built a weapon that could be used for sanctions evasion. If Russia or Iran were to plug into Enbridge, they could trade freely, and the West wouldn't be able to enforce any kind of blockade.
So the BIS exit was them admitting that efficiency had collided with geopolitics.
And they couldn't support the outcome.
Okay, so we have the dystopian control model that's struggling with adoption. We have the Western central banks trying to build this elite version. And we have China building a sanctions-proof trade rail.
But then there's the fourth player, the one the Rapid 2026 report says has already won, private stablecoins.
If you just look at the commercial reality of it, the war is basically over and stablecoins won. That rapid report surveyed global businesses, and 64% are either using stablecoins today or they plan to within 3 years. 64%. That is a staggering adoption rate. And they aren't using it to buy, JPEGs of monkeys anymore.
No, no, the speculative crypto phase is essentially dead for them. This is about treasury operations. If you're a multinational company, moving your own money around is your biggest headache. You've got payroll in Brazil, suppliers in Vietnam, revenue coming in from London.
Right.
Waiting 3 days for a wire transfer to clear is just horribly inefficient. Stablecoins let these companies move millions of dollars, 247, with final settlement in minutes.
It's just a better technology. But what I found fascinating was the political shift here in the U.S. We had the Genius Act pass in July 2025. That feels like the moment the U.S. government stopped fighting crypto and started co-opting it.
The Genius Act was absolutely the turning point. It created a federal framework for stablecoin issuers. But the key provision was the reserve requirement. To issue a U.S. dollar stablecoin, you have to hold high-quality liquid assets, which mostly means U.S. Treasury bills.
And this connects directly to the argument from Stephen Marin at the Federal Reserve. He pointed out back in November that stablecoins are actually good for the U.S. government.
It sounds totally counterintuitive, doesn't it? We're so used to hearing that crypto undermines the dollar. But Miran's argument is that stablecoins create this huge price-insensitive buyer for U.S. government debt. If Circle or Tether issues $100 billion in coins, they have to go out and buy $100 billion of T-bills to back them up.
They're funding the national debt.
They are. They're helping keep borrowing costs low for the government. So the whole narrative flipped from stablecoins are a threat to stablecoins are a mechanism to enforce dollar dominance. The rails might be new and digital, but the underlying asset is still the greenback.
So China is pushing Enbridge to escape the dollar,
Right.
while the private market is adopting stablecoins that actually entrench the dollar. It's a total paradox.
It is. The private sector wants the efficiency of the blockchain, but the stability of the dollar. And as long as that pairing holds, the U.S. maintains its financial power, even without its own CBDC.
Okay, but we can't let the private sector completely off the hook. The winner definitely has a dark side. We have to talk about the Wild West stuff that's still happening. These reports from the UNODC about Southeast Asia they're gruesome.
Pig butchering. It's a horrific term for a horrific crime. These are industrial-scale scam operations, often staffed by people who've been trafficked, and they're targeting people in the West with these elaborate romance or investment scams. And the data shows that Tether USDT is the absolute currency of choice for these gangs.
And why is that? Why not Bitcoin or something else?
Well, Tether is stable, so the scammers don't lose value if the crypto market crashes. It's incredibly liquid. But most importantly, it offers finality. Once you send that USDT, it is gone. There's no bank manager to call, no chargeback mechanism. And because it moves on a global rail, it bypasses all the normal fraud detection filters of the banking system.
And we still have the risk of the issuer itself, right? The Genius Act helps with U.S.-regulated coins, but offshore stablecoins are still a black box. The death spiral risk, like we saw with Terra SD all those years ago, is still a ghost in the machine.
Right. Terra was algorithmic. It was backed by math and confidence. When the confidence broke, it went to zero. The new ones are asset-backed, which is safer, but you still have that run-on-the-bank risk. If everyone tries to cash out their Tether for real dollars on the same day and the liquidity isn't there, the peg breaks.
Which brings us all the way back to the core point from the European Data Protection Supervisor. Whether it's a government coin or a private coin, we have left the era of anonymity.
That is the one constant through all of these reports.
Yeah.
Cash physical paper money is the only truly anonymous, battery-free financial technology left. Everything else creates a data trail. The only question is, who owns the data?
In the CBDC model, the state owns your data. In the stablecoin model, a private corporation, and by extension its regulators, owns your data.
And that leads to the ultimate trade-off, really. We're moving into a world where your wallet has a master.
Okay, so let's try to synthesize this for everyone listening. It's 2026. We look at the board. What do we see?
I think we see three distinct blocks really solidifying. First, you have the China block. They're building this closed-loop, state-controlled trade rail with Enbridge. It's designed for control and for sanctions resistance.
Then you have the Western commercial block.
Yes, fueled by private stablecoins. That block prioritizes speed, efficiency, and deep integration with the U.S. dollar. It has already won the business war.
And finally, the Western Central Bank block.
That's the ECB and the others?
Yeah.
They're playing catch-up. They're trying to offer a sovereign alternative that preserves some privacy and sovereignty, but They're struggling to find a user base that actually cares enough to make the switch.
It feels like the consumer, the average person, is being squeezed. On one side, you have the threat of state surveillance money that can be turned off or told what to do. On the other side, you have corporate surveillance, data mining, platform risk, all of that.
And right in the middle, physical cash is just slowly being nudged out of existence. The friction of using cash just gets higher every single year.
So here's the thought I want to leave everyone with. We always debate digital versus analog. That debate is over. Digital won. The real debate now is this. If you had to choose a master for your wallet, a government bureaucrat who's worried about social stability, or a corporate CEO worried about compliance and profit, which one of those scares you less?
It's a pick your poison scenario. But I think the takeaway from the success of stablecoins is that people seem to fear the inefficiency of the old system more than they fear the surveillance of the new one. At the end of the day, convenience is the ultimate currency.
Convenience is the ultimate currency. That's a frighteningly accurate way to put it. We're going to be tracking the fallout from the Genius Act and the Enbridge expansion in the future, so keep your eyes on the plumbing.
Always watch the plumbing.
Thanks for diving in with us. We'll see you next time.